Hi, everyone. My name is Blair Pierce, and I'm the Operations Director at Think Realty. I want to welcome everybody to the first ever Think Realty Plus Resident Expert Workshop featuring Aaron Chapman. But before I hand it over to Aaron, I just want to give everyone a quick overview of our newest and most exciting membership option called Think Realty Plus. With Think Realty Plus, you'll receive anything and everything that we have and that we offer to help you succeed in your real estate investing journey. With Think Realty Plus, you'll receive, and these are a few different options, virtual workshops with Think Realty resident experts like you're seeing today with Aaron Chapman. You'll also receive virtual investor roundtables featuring small group discussions and networking, virtual interviews with must-know industry personalities, tickets for both you and a friend to all of our Think Realty events. We generally do at least 2 of these per year. We have a virtual one coming up as well, so you'll receive free tickets to that. Event replays. So if you aren't able to attend any of our events, you can pick up our app or go to our website and watch event replays. You're also able to promote yourself with new member spotlight feature, and we'll put that on all of our social media as well as on our website. You'll receive 20% off on all of our advertising, no matter what it is, whether it be magazine, newsletter, e-blast, podcast, webinar, any of those. And then you'll also receive all the benefits that are included in your free or magazine membership. So you'll get Think Realty magazine delivered bi-monthly to your door. You'll get discounts at a ton of suppliers. You'll also get unlimited articles on our website, resident expert courses, templates, checklists, ebooks, and all the industry updates, education, and everything will be delivered directly to your inbox. So since this is a brand new membership that we just launched just a few days ago, now through the end of April, you can sign up with the code LAUNCH and you'll receive this membership for only $14.99 per month. And that's even after the promotion period ends. So you'll get that for $14.99 per month. All you need to do is go to thinkrealty.com/login or thinkrealty.com/join/plus, and there's a couple of QR codes that you can scan right there. And with that, that's a little bit about Think Realty Plus and one of the benefits, such as this workshop that you'll receive. Let's hand it over to Aaron Chapman. He's going to discuss interest rates and what influences them. He was just in Phoenix and taking a little bit more of a deep dive on that subject. So welcome, Aaron Chapman.
Thank you very much. I appreciate it. So I didn't realize this is the first ever that you guys are doing, and let's hope it's not the last ever because of how this one goes. So with respect to the interest rate thing, that is the one thing that I'm asked about the most, is when are interest rates going to go down? That seems to be what everybody wants to know, and everybody's asking me to dig out that whole crystal ball thing and figure this out. What I can tell you is not so much when they're going to go down, but my belief is I don't know that they're really going to. And we'll get really deep into that. And the reason why I want to get into that is kind of give you confidence as to where you're heading as a real estate investor. Because real estate investors, unfortunately, have been taught over the last few years that you want to focus on a specific metric. So I wouldn't say they've been taught to just focus on that, but it's really been highlighted. And the metric that you're going to look at a lot in what would be provided to you in the form of a pro forma would be something referred to as the cash on cash return. So you look down at that, or the cap rates. Those are all great metrics. Things are going to help you understand that property's ability to sustain itself, which is what you want that property to do. You want it to be able to, make the payments, provide some cash flow, set aside enough to be able to deal with other situations might happen, like breaking mechanicals, other issues that could come about. They're going to have some expenses, because just because you buy the property doesn't mean the costs are going to stop. So what I want to get more into is the history of the interest rate. So I'm going to share some screens here. The first of the screens that I'm going to pull up, if it would actually work, here is the actual interest rates themselves on a 30-year fixed mortgage for your owner-occupied loan. So I'm going to take this all the way back to the beginning, and this starts on actually literally looks like over 50 years ago. We're looking at April 2nd, 1971. The average interest rate at that point on a 30-year fixed mortgage for a person buying a home to live in was 7.33%. So then you start, ripping along through here, start seeing the interest rates climbing to 8s, 9s, 10s, 13, 16. See, you'll see probably an 18 in there somewhere. I just probably blew right by it. But we scoot all the way down to the very bottom. What we're seeing today is they're claiming the average interest rate for a person buying a house to live in is about 6.8. Bankrate.com might tell you 6.9 to 7%. But what I do is I average the rates out for the entire period of time from 1971 to today. That is 7.73%. That's an important number to look at because we have this misnomer that interest rates are going to go back to what is historically an average. Well, historically an average, 7.7%. And when you look at the rates that we've had over the last few years, interest rates as low as 2 and 3%, that was a big anomaly. That's not something that we saw within a short window of time. So what drove that? People would like to know if they even want to even consider, why did we have interest rates so low at that period of time? We don't have them that low now. So I'm going to share another screen with you. We're going to get into something pretty deep here called the mortgage-backed security. I don't know if you guys have seen the movie The Big Short, but I would highly encourage you to check that out. Now, if you're going to go get that movie, I think it's on Amazon Prime right now. I don't believe you have to pay for it. It's part of the Prime package. If you're going to watch it, I would say keep the kids out of the room, do it later at night. There's a lot of language on there that might not be appropriate for younger audience, but it does illustrate the history of the mortgage-backed security. It goes back into the 70s, where, as you can see right here, 1971, when they started doing that. An individual by the name of Lou Ranieri that worked for Solomon Brothers, worked in the bond department, if you will, or the bond market on Wall Street. And he decided that there's a lot of money being made by the local banks. I'm going to actually take this screen off real quick. Let me kind of get into this a little bit deeper. There's a lot of money being made by local banks where they would take local depositors' capital, put into checking, savings, CDs, and then lend it back out to the community for their farms and their houses and their businesses. Now, if you look back during that window of time, interest rates being as high as they were, and this was actually in the later 70s and the early 80s, those higher interest rates were pretty significant compared to what they're paying out to a person on their checking, savings, and CD account. Now, they're pulling in somebody's capital, lending it back to them at a higher rate. And then as they get that interest back and only giving them a small piece of it keep for themselves, you can see the big margin that was there. And that was what was attractive to the group of people working with Lou to say, hey, we can put this together on a larger scale. Build big pools of money that we can have people from all over the planet invest into. It could be, whether it be corporate bonds, it could be retirement accounts. You've got a whole bunch of different institutions, even countries would take large sums of capital, dump it into this pool, and get a large return. And they would keep a fraction of that for themselves to continue to manage it and maintain it. Well, the bond market became a rather sexy place to do business in. As a result of that, they were lending out to the world. They were building up people getting their houses. It was the American dream being lived, and there's a lot of money being made. But what happened is people traditionally, if you think back to your childhood, I was born in 1974. A lot of people didn't move regularly. My grandparents stayed in the same damn house from the 50s on until my grandfather died. My uncle, same thing. He moved into his house when I think it was before I was born. He died in that house. Actually, not dead yet, but he's not far. That's a common thing for a lot of people back then. So they weren't seeing a lot of that turnover. So the people in the bond market putting the money in there were not seeing as much movement. So we had to get movement happening. Then you get the 90s. What happened in the 90s had to do with your little bit more aggressive style financing. They were doing the no income, no asset kind of loans. Then we got to the extent of doing 100% financing on investment properties with not declaring any income, making it up. Well, then you get further into the movie The Big Short, and it starts talking about these groups of people, the people who are just buying houses like crazy, refinancing, 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 taking this money, buying boats, buying Hummers, spending it indiscriminately. And they did it on multiple different houses. And there's only one person reflected in that entire movie that had multiple properties. And so you have to ask, what did Hollywood decide to portray the real estate investor as? And as you watch this, you'll find out. And who they portrayed that person as, keep it, pay close attention to it, is a stripper. So they decided the way to portray the real estate investor, the people that had multiple properties, was a stripper. Now, if that's your profession, you got to pay for school somehow, right? You got to go about life somehow. But I find it interesting that that's the way they wanted to categorize this. So fast forward to where we are now. We get into past 2008. Actually, before we even get to where we are, we start getting into 2009, 10, 11, and 12, when a lot of investors coming into Arizona, where I live, start buying the properties because they can get them very cheap. Rents were high. Cost of housing was very low. Why was cost of housing very low? People were losing their homes like crazy because they overbought, over leveraged, higher interest rates. They purchased multiple houses. They couldn't maintain all these houses because nobody was renting them at the time, and everybody was getting foreclosed on. There's a lot of sheriff deputies standing in people's yards, grabbing their stuff, throwing them out of the home, causing trauma to the kids. That was happening in a significant number. And as a result of that, they couldn't get financing on a house, so they had to rent. What we did is we increased the rental pool significantly. So if you look back in the charts, and I don't have those here, you'll see that even though housing took a massive decline, the cost of housing, the property values, the rents continued to go up. Only during a window of time between 2012 and 2013 did it flatline. It didn't even go down, it flatlined. But this continued decline because of the demand for housing that they could not get as a purchase because of their current financial situation. So then trying to get financing for people buying houses as rentals was very difficult. We struggled with that really hard. Myself and Ellen Schmidt, who's a member of my team since 2010, we've worked together. It was a battle. You're battling with Fannie Mae, Freddie Mac, those who maintain the guidelines, who are securitizing these loans and guaranteeing these loans. They were not really interested in lending out to people who, in their mind, caused the problem to begin with. Well, the problem was caused by greed. The problem was caused by people demanding a certain type of financing, others demanding a return on their investment and get that money moving. So they created something to make both sides happy, and it blew everything up. So fast forward. Actually, no, I'm not going to fast forward again. I'm going to get into the mortgage-backed security itself. We'll go back to that screen I was starting to share. Let me see here. All right. So what you'll see here in these is a specific, each date is referenced right here. This references 1 week's worth of trading in each one of these, what they call candlesticks. Each one of these references will show, let's just say this one right, cursor is on it, starts at this point, it ends at this point, meaning it was a day where it traded upwards, meaning money moved into that particular market that day. It's called Japanese candlestick. So if it's green, it means it started low and ended high. If it's red, it means it started high and ended low, meaning people sold out of their positions, meaning it was a down day, money moved out of that security. So as money moves into security, the increase of capital goes into it, the interest rates will drop a little bit. Now, you won't see a direct drop in the rate, but you'll see a drop in the cost associated with the rate, depending upon how much it moves on a day-to-day basis, and this is showing a week-by-week basis. But what I'm pulling up here goes all the way back to November 25th. It's actually 25th, the day that this happened. I'm referencing the week here. So it's the week starting November 24th of 2008 is when the Fed announced what they called quantitative easing. So before that, this is what the market was before that, and I don't have charts that go back even further, but we know the interest rates were, I could actually pull them up over here, but ultimately the interest rates are very similar to where they are today. And then at that point, the federal government says, hey, nobody's wanting to lend their money out. We have this credit crunch. So we're going to inject capital into the markets, and into the mortgage-backed securities, into U.S. Treasuries, and into corporate bonds to stimulate the economy. So that was a combination between Hank Paulson, who was the Secretary of the Treasury, and Ben Bernanke, who was the Chairman of the Federal Reserve. Their collective mind said, we're going to do this. We're going to take money from the U.S. Treasury, which are going to print it out of thin freaking air, hand it off to the Federal Reserve, and they're going to then inject it into the markets. One of these places is mortgage-backed securities. So that date of that announcement, all they did was announcing it. You can see this big jump right here. Now, it may not look like a massive jump to you, but this is a normal week's trading right here. That is a massive jump. That's a couple of months worth of trading all in 1 week where that money had injected into it. Well, then we fast forward up here into January. 1st of January is when the Fed actually started investing capital into the mortgage-backed securities. The federal government invested they invested $1.25 trillion into the mortgage-backed securities starting on January 1, ending on March 30th, 2000. So it was 1 year and 3 months, $1.25 trillion invested into that to stimulate the economy, and they continue to keep investing it. So now what we do, we show you the entire history of this security that will be shown on this chart. It's going to take a bit for me to get it all in here. Here we go. Excuse all this. It's rather finicky. So what I'm showing you is from this date here that we talked about, November 25th of 2008, all the way on to where we are today. But if you look at all this movement, look at that is a significantly large amount of movement, an enormous amount of capital going in to bring the interest rates down to the point that they did. This represents $8.9 trillion from this date here to this date here. And this is November, the end of November, actually end of October 2021. All this was the federal government shoving capital into it to keep the interest rates low. They did attempt to do this back in 2017, what they said called the quantitative tightening. And when they started that quantitative tightening, the market freaked out. A lot of jump in the interest rates, a lot of negative movement. So the Fed decided to put the money back in there and keep reinvesting up until the end of 2021. Then we see it fall off a cliff. What that means is when the Fed said definitively we're going to stop investing capital into the mortgage-backed security, a lot of people pulled out. Now, you can't pull out immediately, right? They're going to pull out slowly because they have money already invested. It's already taken and put to use. So they can't just suck it all out. So they pulled all that, started pulling capital out, and we fell very, very hard. Now, right about in this area, and I'm going to have to try and see if I can zoom in right here. It was about the February of 2023, kept getting this question, when are rates going to go back down? And we're bouncing along this kind of flatlining this area with the trades. And when I'm watching these charts, I try and figure out where is the bond investors going to invest capital into it, and where do I believe they're going to pull capital back out. As I'm looking at that, that's when I decided to go all the way back to 2008 and figure out what day did the Fed decide to inject that capital in, and that's when I drew that line. I hit that line that I showed you guys right over there, and I'm going to have to right there. November of 2008 is when I put that line to reference. This was the point where the Fed announced it. And I believe, it was my belief that the market before that was being supported by the market, by average investors putting money into this, feeling secure in mortgage-backed securities. And everything above that point would have to be strictly because of the Fed's involvement in quantitative easing. So if I fast forward, I drew that line across and said, that should be our ceiling. I believe that to be our ceiling. Now, everybody else out there, every guru in the market never talks about it. They have yet to even talk about it. I've been talking this for well over a year now. We're coming up on a year. And lo and behold, as we continue to trade into 2023, it was May of 23, we went below that level, and we've stayed below that since May of 2023. Now, the market continued to decline, meaning people selling off their position in mortgage-backed securities, therefore pushing interest rates up because of the economic data that's being given to us. That economic data was saying jobs are looking good, the economy is being stimulated, inflation's doing well, all these things. So anybody investing into a bond would not go into a bond. They want to go someplace else. If the economy is doing well and jobs are up and all these things are happening in the favor of the economy, they want to be into equities because that's where people make money when the economy is booming. But then you would start seeing after these jobs reports come out that there'd be a revision for the previous month on the back page saying, oh, we were off by 100,000 or 200,000 jobs. And you start to climb into the data that's being provided by the Bureau of Labor Statistics, and you start to find out that they were kind of using algorithms and formulas that were, quite frankly, bullshit. one of the formulas they did, they were taking a population formula saying, well, if our population is increasing by a certain percentage on an annual basis because of immigration, a certain percentage of those immigrants should be getting jobs. Therefore, we should add that in there, even though we cannot confirm it. And therefore, they're coming up with a bullshit jobs report. It wasn't until October this last year they started getting a Realty jobs report, because you only fake it so long before people start calling bullshit. So when they start getting Realty jobs reports saying things are actually worse than where they believe them to be, and the economy is actually in a lot worse shape, the market rocketed right back up, a lot of money moving right back over to mortgage-backed securities and the treasury bills, the 10-year, if you will, away from other potential risky investments, and shoved that value right back up to where? That ceiling that I marked back a year and a half before, that references the date they announced quantitative easing. This is a very significant thing to point out, because if you see here, it bounced off of this several different times. Hit that line, hit that line, hit that line, and has never been able to break it. Why? Because the investors themselves, those who are put their money out there for whatever risk they believe it's going to be at when that particular security, do not feel comfortable going below this point that was established way back then. That's my belief. And it's been proven by what the market has been doing over and over and over again. So why is that important for you to know? It's important for you to understand this, because it's until there's a reason to put more capital into these pools and increase the value of the pools, or at least the accessibility of it, the interest rates are not going to go down. It's a supply and demand thing. If you're going to a grocery store and you see 4 tractor trailers wrapped around the grocery store, it says got milk on the side, milk is going to be very, very cheap. But if you walk into the grocery store and there is just a crate with 4 gallons in it, a big crowd standing around the customer service desk, the store manager auctioning them off 1 gallon at a time, it's going to be very expensive for milk. That's the same concept here. The more capital that goes in there, the lower the interest rates will be. We are right now stopped at that point. We are going to see the interest rates hold at that point. So what we have here, my belief and the belief of many around me that are in my space, are of the belief that we are going to see this continue to follow this specific trend. I drew this channel right here to show the channel that it followed, the traders bouncing in, and then I drew the channel way back in this area, and it followed exactly what I thought it would be till there was a reason for it to fall out of it, climb back through the channel. It's going to follow that same pattern. It looks like it's going to continue to follow that pattern. I refer to this as a blue pill market, because it's going to be higher for longer. Interest rates going to be higher for a lot longer period of time. So that's what we're going to be seeing. I would say probably for the really foreseeable future. Now we have some other things that are going to be an issue. They had talked about this last year that we're going to have 4 Federal Reserve rate cuts. We've already passed the opportunity for 2 of them. There's a belief that we may have a couple at the end of the year, towards the latter half of the year. But that, I think the last thing that I've heard is about a 70% chance they're going to do a rate cut this year. That has dwindled down to about 53% chance. The economy has to show a lot more weakness for the Fed to do a rate cut. And why is that? Why would the Fed cut the rate versus raise the rate? Well, the reason they even raise the rates is to increase the cost of overnight or short-term borrowing. That'd be credit cards, that'd be cars, that'd be credit lines, those kind of things. What do people use short-term borrowing for typically? Your credit cards used to go buy just goods and stuff. Well, if it's more expensive, your credit card rate goes up significantly. Traditionally, people would slow down their buying because their monthly cost on that rate of that credit card is getting very, very high. But what we have proven as really a instant gratification economy, that we just love punching the button. I don't even know. It seems like nobody even gives a damn what they're ordering from Amazon anymore. They just want to click the buy button. It shows up, it stays in the package, it's still on your table for a week later. You just love buying. And because we as a society just love to buy and piss away money on things of zero value, we're going to continue to keep pushing up inflation. If you look at inflation today, they're saying it's just under 4%. I don't know that that's accurate. In fact, I know it's not accurate. And I'll pull up a site to prove otherwise. I should have already had that up. So if you guys are on your computer, I would encourage you to go to shadowstats.com. Again, that's shadowstats.com, as in shadow statistics. And I'll show you on my screen what you want to look for. So in looking at this particular site, you want to go over to the alternate data tab. You want to scroll down to inflation. This is going to give you a breakdown on inflation. Now, what's interesting about this, it references these two different charts, but this is the one that I want to point out. Let me see if I can even zoom in. I don't know if I can. Yep, there we go. This particular one, it shows you the consumer price index. Now, in my opinion, the most grossly mislabeled sumbitch on the planet. Because when you say consumer price index, it means you should be understanding what people spend or the price of things that people are consuming. But the federal government will only track certain things, those certain things that they can do to be able to keep an eye on what's happening in the market, but only in certain areas, mostly durable goods. And then they actually kind of jockey with the math on things like housing and other items. They have a substitution process in there too. So it may not be exactly what you're spending on, but what you could spending money on if you didn't really need to have the best of the best. So they're trying to gauge your cost of living, but they're not doing a very good job of it. But they are doing it in a way to make it look better for them. So back in the 80s, they used to track exactly what people spent money on. But then as they started messing with it, manipulating it, you'd follow this red line here, and that follows what the Fed is following and what they're tracking in their index. The blue line continues to track what they used to track as far as what people would spend money for goods and services on a month over month or year over year basis. So what we're showing here is an average person right now, according to CPI, is about 4%, a little over 4% for your consumer price index from the Fed, but when you get into the real rate of inflation, it's closer to 12. Now, let me tell you about how inflation works. Everybody believes that inflation means the cost of things are going up, when in reality, that's not the case. It's the value of the instrument you're buying those things with is going down. So back in the 1920s, you could get a $20 gold piece. Back from the 20s back end earlier, I have an 1888 one. I was going to have it for this thing, and I left it in my safe. So an 1888 gold piece, it was worth $20 at the time. I could walk into a department store if I was living back then and get a hat, a suit, a tie, a shirt, a belt, a pair of shoes, and a pair of socks for that $20 gold piece. Today, you'd be hard pressed to buy a decent pair of socks for $20. I know, because mine cost a hell of a lot more than that if you want socks that last. But you could buy everything I just named with an ounce of gold. Why? Because the ounce of gold is over $2,000. A suit, all these things could be about $2,000. It's not that the gold has gone up in value. It is not that the cost of those materials or those materials have gone up in value. It's that the instrument we're exchanging for those materials has decreased in value significantly. I used to be able to walk into Taco Bell. I don't do those anymore, but back in 1993, I could pick up off their value menu, 2 bean burritos, 2 tacos, and a drink for $1.99. $2, I could feed myself. I was taking my daughter over something back at her school in the afternoon earlier this summer, and we swung into a Taco Bell. That's what she wanted, and she ordered those exact things. It's not like there was a value menu on there that had those. She just ordered those exact things with a drink. It was $15. Now, the cost of Taco Bell's crap that they shove in there has not gone up. It's, again, what we're exchanging for that has gone down that far in value. So why do I talk about this? I need everybody to get your calculator out, because we're going to explain some things now that you understand a little bit more about the inflation and a little bit more about what goes on with interest rates. The whole point behind all that background is to give you a little bit more confidence into what it is that you're going into and why buying investment properties now is still a good thing. Now, Blair, I don't know if you're still available. How much time do I have? I didn't know how much time you guys were giving me. I want to make sure that I don't just completely bury everybody for the entire night. And he may not even be here anymore. Blair may have just ridden off into the sunset and just Aaron's on his own, which is possible. So you can put it in the chat if you like. So I'll just keep rocking. So the
Chapman, you got 30 more minutes. It's Carmen. We're
30 more
7
minutes.
o'clock, but you
Thank
can
you,
talk
Carmen.
about if you want. I'll listen.
So it might just be me and Carmen here tonight.
I'm with you too.
Very good.
I'm here. I just couldn't find the button. I lost it.
Believe me, when you find the button, it's an amazing experience. Let me just tell you.
That buy button for me.
I highly recommend the button. So getting into how to help make you a little bit more of a confident investor in today's environment, and why interest rates really don't matter. So let's say you're buying a $200,000 house. And I did this from the stage, but I can say this 1,000 times, and it's only going to be caught by probably the 6th or 7th or 8th or 10th time. So you're buying a $200,000 house. You're going to put 20% down. That will be, if you run the numbers, I usually have somebody on here to run the numbers with, but I'm not going to call anybody out. That's going to be $40,000. 20% of 200,000 is 40,000. That's your down payment. And let's say because of the situation in the market today and the interest rates all over the place, between lender fees, title fees, appraisals, taxes, insurance, all these things, you're going to pay $10,000 in costs to get into this property, costs and insurance and taxes and all these things. That means you're investing $50,000 into the property. That's your investment to buy a $200,000 cash flowing asset. Well, that asset now comes with a loan. That loan is $160,000. Now you have basic jobs of you as a real estate investor, as the CEO of your real estate investment business, is you have to pick the right people to interact with in your business, right? A CEO just doesn't hire the cheapest people to be on their board and be on their executive team. They hire the best people they can to be sure that they are successful as a business. So you're going to get the right lenders, the right, I'd say, appraiser, inspector, real estate folks. You want really, really good property management. You get all those people in place. You should be able to keep that property reasonably rented the entire time you own it, and you can raise rents on it, and it should appreciate a little bit. Now, if you did that and did it well, picked the right property, and it stayed reasonably rented the entire time you owned it, who pays off the mortgage? A $60,000 loan. That will be your tenants or group of tenants over the term that you have this property. Now, we're going to say you're going to keep it the entire 30 years that you have this loan. So these people pay off that mortgage for you over 30 years. So you take the $30,000, or excuse me, the 30 years, and let's go to the loan size of 160,000, divide that by 30, which is the 30 years it's going to take to pay them off. So 160,000, get your calculator out, divide it by 30, and then you'll get how much they're giving you every year, averaged over 30 years. I realize that there's an amortization table. We're doing basics math, not really deep, detailed math. So paying it off over 30 years, you're going to find that they're basically giving you $5,333.34 per year. That's coming back to you just by paying off the mortgage. You divide that into your $50,000 investment, you'll find that your $50,000 investment is growing by 10.66% every single year. That you are receiving. That's your money. But it's not money that's going to your bank account. It's going into the paying off of your asset. Now, we set that aside, 10.66% gain right there. Now, with this inflationary environment we live in, we get to see the property values are going up year over year. Case-Shiller, Black Knight, CoreLogic said last year is about 6.8% increase over the last 12 months. So properties are increasing by 6.8%. We're going to say you're finding a market that's just a consistent 2.5% every year for the next 30 years. Not a sexy number. Nobody gets excited about 2.5%, but let's talk about how exciting it can become. You have a $200,000 asset that increases by 2.5%. What's 2.5% of 200,000? The quick math, you'll find it's $5,000. Your $200,000 asset increased by $5,000 the next year just because of your $200,000 asset increased by $5,000 just because of 2.5% appreciation. But you take that 2.5% appreciation, which is $5,000, calculate that into your $50,000, you'll find that's another 10%. You're making 20.6% on your investment, which was $50,000, just by having somebody in there to pay off your mortgage and having it in a market that's going up at least 2.5%, which is extremely achievable in the economy today, especially in places where people are buying houses to rent out. Not in all markets. In fact, all markets are doing better than that, but we're just going to focus on the markets that we do business in. So 2.5%. That's significant. 20.6. Now set that on the shelf. Now let's get into the thought process of the rent. You say you're getting $1,800 a month rent on this property. It might only generate $100 a month cash flow after you pay all things and set aside capital for expenditures later for maintenance and vacancy. And we're talking about this as if you're going to have vacant points in the 30 years. That's where the cash flow is going to go to help that out. That's why we're just looking at this as spread out over the 30-year window with these averages. So let's say you're averaging $100 a month cash flow over the period of time that you own this, but you get to raise rents. Now we're seeing rents going up. The last I checked was 6.5, 6.6% across the United States. I know it's happening here in Arizona that much. So 6% on $1,800 is 54. Excuse me. We're going to take that 6%, cut it in half, go to 3%. 3% of $1,800 is 54 bucks. Please run that number to be sure. I always like to cut everything in half or even lower. So 3% increase on your rents that you're charging of $1,800 is equal to $54. Nobody gets excited about 54 bucks. No investor is going to say, I'm going to buy that house because I can raise the rents by 54 bucks. But the flip side is that your tenant doesn't get excited about 54 bucks. They're not going to freak out that you raised their rent on a 2-bedroom or a 3-bedroom or 4-bedroom house by $54 when they know the apartment complex down the street's raising it by $100 to $200 a month. So you're able to retain tenants. What's interesting about that $54, it increased your $100 cash flow by 54%. Now you start doing that math and adding that up year after year after year, year 5 starts to get pretty damned exciting. You're back to that cash on cash return metric that you're hoping you're getting to begin with. It will get there eventually. So don't get so excited about what the first year's cash flow looks like. It's can you raise rents or can you not? So now you know you're getting this compound increase. Every time you raise the rents on the base rent, the $1,800, even a small amount like 3%, you're seeing double-digit increases in the cash flow. So we're going to set that aside. That your cash flow is growing. We know that. Now we get into what's happening with the lender. So the lender has got you set up for 30 years. You're going to pay that mortgage for 30 freaking years. I'm actually going to share screen something here so you guys can take a look at this. If I can find my cursor and the button. All right. So I don't know if you guys see this. I hope you can. I'm showing you a $200,000 mortgage purchase price right here, $160,000 loan. Today's average interest rate is 7.63%. Now, what we also have is a full amortization schedule here that shows you making a payment on this. 7.63% interest rate on a $160,000 loan is equivalent to $1,132.47. Added up over 360 months, that's $407,689.20. That's a significant amount of money. Now, what we're being taught and have been taught all through the dawn of time, that if you want to pay your mortgage off early, make extra payments, take your cash flow, do the debt snowball. If you have 10 houses making $100 a month cash flow, take that $100 a month, which is an additional $1,000 from the 10 homes, and start paying this off and pay it off early. I'm telling you, don't do that. And here is why. Yes, you're paying $407,689 $1 bills over 30 years. But we talked about inflation, what it's doing to the US dollar. We talked about what happened to that $20 gold piece, how the gold piece is worth over 2,000 now when it was worth $20 before. It's because the instrument we're paying it back, we're actually purchasing it with, is losing so much value. So when you recalculate the value of every dollar that leaves your hands to pay the lender, it's not worth $1,132 anymore. It actually drops by 0.666%. So that being the case, we recalculate all of those over 360 months. The value of the dollars you give, even though it's 407,000 of them, the actual value of them, compared to the day you borrowed the money, is $154,336.97. That right there is the significant power behind leverage. So I tell everybody, you're always going to make money on somebody paying off the note. You're going to make a ton of money off the property value, the property appreciating. You're going to have money coming in off of cash flows increasing. But where the real wealth comes in is by giving back less than what you borrowed because you stretched it out over time. Now, who benefits? And I'm just going to make you think about this because I know nobody's going to answer the damn question because you're all on mute. But who benefits when your total focus is the interest rate? And that seems to be the thing everybody keeps talking about, rates. Let me just make you think about this first. What happens when the rates go down? If you're sitting here right now waiting to get into the market and buy a home, an investment property, or another home until the rates go down because your lender over here says they're going to go down. They keep talking about how they're going to drop the rates, and yet they haven't done that. What's going to happen at that point if it actually does? Let's say I'm wrong. Let's say the rates do go down. They go down to 5%. What's going to happen to the price of housing? You remember that window of time a couple of years ago when the average realtor would say, if you're going to start bidding on this house, you need to come in with an offer 20 to 30,000 over list just to get in the game. Everybody that had now the ability to afford more paid more because that lower interest rate that you were getting this discount on the house because of the low cost of money you're going to pay it back with was paid in advance by the increasing purchase price, and it hasn't slowed down whatsoever. So if you're waiting for that to happen, expect to pay more on the house and actually pay out what you would have saved just by buying it now. So let's get back into what we were trying to remember. What was I going to talk about? Somebody's going to have to help me out here. My mind just went blank. Well, I'll just take the whole conversation in a different direction if I have to here. So what we've got is Oh, this is good. This is really good for me to go blank here because it was, I'm trying to remember where I was heading with this whole situation here with the interest rates going up. So let me just kind of turn something on here when it comes to the long-term leverage. When a lot of people will start thinking of, well, there's a lot of different other loans out there, a lot of different options out there. There's a lot of things I'm being told I could do, like a zero down kind of a loan with a short-term rate that has been touted a lot as a more experienced investor type of loan. I wouldn't listen to that. That takes us right back to 2008 when people were getting zero downs. And if the market does shift the way that we believe it's going to, we may have a lot of areas that may not be able to sustain this growth, and you're going to put yourself in a really, really negative position. So don't let yourself get into that. Don't let yourself get suckered into that kind of thing. You always want to have the equity, put the money down. Now, there's a strategy out there that we talk about quite a bit called the burr strategy. There may be a lot of people on here that have thought about that or heard about that. I want you to, if you're considering that, if that's something that pops into your mind, to think, maybe I want to do this burr strategy thing. And that is, you're going to buy the house, rehab it, then rent it out, refinance it, then repeat it. Well, I'm going to tell you, you need to flip some of these because it's not going to be a rent and refinance. They say it that way. You want to rent it out, then refinance. You want to get the refinance started before a renter comes in. I don't know if you've ever seen how a renter moves in. You can have the nicest home in the world. The second you send the appraiser in there and the renter is just started to move in, it doesn't look as good a house as it did when you were done with it. So always get the loan started in advance right when you buy that house. But here's what you want to do before you even buy the home. Talk to me and talk to my team. You do not want to put yourself in a position where you're paying cash for a home and then trying to do a refinance it and get your money back out if you haven't set it up properly. When it comes to that specific kind of thing, buying a home that needs a refinance on or rehab on it, let's just say you're buying it for $50,000. House is in really, really poor shape, but put $30,000 in, it'd be worth $150,000. Well, we know you can get a refinance up to 75%. You should be able to get your money back out of it. In that scenario, you would not be able to if you paid cash for the house, then paid your contractor after the fact. Because the rules on refinancing homes in the conventional lending space, and really most spaces, is they'll only go up to 75% of the value of the home, not to exceed what you invested at the closing table. Well, you invested $50,000 at the closing table, but you put another $30,000 in after. You put in $80,000 into this home. It's worth $150,000, but you can only get the $50,000 back because of the way the rules are structured. So what we do is help people do something to the effect of go to the closing table with the entire $80,000. You'll give that to the title company. They'll take 50 of it, pay the seller, and make them leave and hold the remaining 30 in what's called a repair escrow. They can then pay your contractor for you. Because of that, we show you brought $80,000 to the closing table. I can go up to 75% of the value, not to exceed your initial investment closing, which is the $80,000. You now can get a refinance and get all your money back. You're in the deal for nothing. So this is where the calculation gets really, really awesome. If you have no money tied up into it, you've invested none of your capital into this, what is your return? It's infinite because none of your money is invested. There's a lot more ways to go about this. If you find that you did one of these, and you got yourself backed into a corner and you not own it, can't get your money back out of it, you need to call me. There's about a dozen different strategies we can go about this. There's a dozen different ways we can get you out of this. So do not ever go into a cash purchase without talking to us. Well, I talked earlier a little bit about who wins when you think about the interest rate being the most important part of the deal. Let me tell you, it's the lender. You've been conditioned by the banking industry to think the interest rate is what is the most important part of the transaction. To the extent that people refinance at a regular basis and regular intervals to get their interest rate down. If you look back in history, I know that right now the history is going to be a little skewed because of those really low rates we had because of quantitative easing. What I can explain to you is that historically, you'd see people refinance their homes every 4 to 5 years, or 4 to 6 on the average. So let's say it's 5. Actually, I'll just use an example that I've got. I had a client come to us with a $120,000 loan when they bought the home, and they wanted to refinance it on month 47 of the payment. They came to us to do this loan. 47 months in, they're like, I've got the rates have come down. I want to do a refinance. I always encourage people to pull cash out to reinvest it in the market. Say, how much cash are we doing? He says, no, I just want to refinance the rate and get a lower payment. I tried to explain to him how that is detrimental to him. That's not the thing that he wants to do. Could not convince him to do that. Could not convince him to go to think differently. We continued with that transaction. Now, when you do the math on it, he paid on it for 48 months by the time we got this transaction complete. he had paid almost $38,000 in principal and interest. 38,000. It was about 37 and change. Left his hands to go to the bank to make payments on this home. But the balance dropped only about $6,200. It was 115,800 approximately is what the balance of his loan was. By the time we were done with the refinance, he added back the cost to the mortgage to where his new loan was 119,800 and I believe is $87. It was $103 off of his original balance. 4 years later, he paid nearly $38,000 in payments, refinanced his house, and had the balance right back where he started from within $103. Who won? The banks killed him on that because they collected so much interest on the first 5 years. Look at your amortization schedules. The first 5 years is extremely important to the banks, and it should be very important to you. That's when you get the most marketing and the most pressure to refinance your houses. Now you can see, why would anybody want to do a mortgage for somebody at 5% or 3% or 2%? Because they can collect so much interest up front, convince you to refinance and do it again. Now, if this guy continued to do that, he would have paid $180,000 in 20 years on the multiple refinances that he'd done, but still retained the exact same balance on the mortgage. It wouldn't have changed. So he has continued to be in a way, more or less a servant to the banks. That's not going to be the only way they're going to do that. I'm trying to stop that for one thing. The other thing that's happening is with the hedge funds. They bought 44% of the housing last year. 44% of the single family houses were purchased by the hedge funds last year. And the hedge funds, they are BlackRock, State Street, Vanguard. Jeff Bezos started one up. He now is starting this fund where they're collecting capital, buying houses. What's interesting about this collection of capital, it's not their money. It's other investors' money. So they can go out and buy houses for more than they're really worth and not care and start setting the market. What you are subject to at this point, and what everybody's subject to at this point, is us turning into a subscription-based economy. What does that mean? It means everything you have in your life, you have to pay a subscription for. BMW tried this shit not that long ago. So you can buy a mid-grade to higher level BMW, but you have to pay a subscription for all the things. You want the seat heater to work? Pay a subscription. You want the, I think it was there's a bunch of the little tiny features. They wanted you have an subscription. It didn't go over well. People pushed back and it didn't hit. Do you think they're not going to try it again? Do you think that everybody else is going to try that? Well, the hedge funds are going to do that with housing. So you as a real estate investor have one shot at really being able to get involved. I think it's now. If you're not taking advantage of the opportunity now, and you're not jumping into it and looking at housing, buying houses, financing houses, talking to some of us that have been there for a very long time, I own real estate in 6 states, you're going to get yourself in a situation where you're not going to be able to participate in it. You're going to be either a subscriber or a person offering the subscription. And if you're offering the subscription, the rate that you're able to get money in on that subscription from your subscribers is going to be set by the market, which is the bulk of the money coming from the greedy bastards that is the hedge funds. We know how those pricks work, and since they push everything up the way that they do, you will benefit from that. Who else benefits? Your children, your grandchildren, and your great-grandchildren. That's where my objective is right now. It's where I'm focused right now, is my great-grandchildren. Because I know that if it continues on this path, there's no way in hell they're going to have a shot at it. So we're taking the capital that we have, and we're trying to invest in houses in different places where our family is going to live. Everybody within my family rents from our family trust. I'm the first person to create the trust within the family. I had a conversation with Eddie about this before the event we had this last week. And he brought this up in a live podcast where we were having the conversation about this. Usually asked about interest rates, but he asked me about what I'm doing with the family. So there is, if you think back on, let's say, the Rockefeller name, there was the Rockefellers before John D. Rockefeller and the Rockefellers after. Before that, before John D. Rockefeller, nobody gave a shit about that name. Nobody cared. But then he came along and changed everything. Now you remember that name. There's another name that stands out, Cornelius Vanderbilt. The Vanderbilt name doesn't mean as much as it used to. He was the richest man on the planet, but by the third generation, the wealth was gone. There's not any millionaires in the Vanderbilt family, especially from the estate. The estate's wiped out. It's gone by the third generation. What do we do to change that? You're going to have an opportunity within this series that we're doing, or Think Realty's doing, with some guys on the infinite banking. You're going to have a couple different fellows that are part of this ecosystem. They're going to share this with you. I would say that you want to take notes. That is one of my favorite things in the world to help a real estate investor get started, is to introduce them to the infinite banking strategy. When I was introduced to it, I thought it was the dumbest damn thing I could have ever heard of, because it's tied to life insurance. I have been screwed by more than one life insurance agent because they sell you something that's not reality. But when you start understanding the whole life policy, it becomes the foundation of your real estate investment business. I encourage you to look at that, look at it very closely. I'll just tell you my own story. When I'd heard that one of my clients, a very, very good client, had financed 17 houses with me, had retired from his career with the military. He was the captain of the USS Tucson nuclear submarine. He worked at the Naval Academy as an instructor, and then at the Pentagon for the chairman of the Joint Chiefs, was on his way to become an admiral when I'd heard that he retired from the military to sell life insurance. I thought he was insane. So I contacted him directly, which is I'll do with you if you do something I think is really freaking stupid, because why would I have you sacrifice your real estate investment business and your business period that's going to affect me? And it's going to affect my team. It's going to affect people like that are selling houses to you and help you build your business. Dumb moves by you affect us. So when you start to fail, I start to fail, and I violently oppose failure. So I called him and I asked him if he was freaking stupid, directly to his face, a little bit stronger language than that. He laughed about that and said, I won't answer that question until you get your wife on a video conference call with us. So in October of 2016, we did a video conference call. Now, I had set aside $90,000. I got a deeper story as to what had gone on before that, because the crash of 2008 and a personal accident and a whole bunch of things that had occurred to me. But I had finally gotten to a point where I got my credit repaired, paid the whole world off that I owed, put aside $90,000, invested in real estate. By the time I was done hearing about this, I took that $90,000. I purchased a life insurance policy on me with about a $2.7 million death benefit, but then was able to borrow against that cash value of about $80,000. He invested 90, was able to borrow about 80 against it, invest in these properties I planned on. The properties are generating enough cash flow to get about $600 a month from them. Plus, I take 10% of my income. That 10% is how I saved the 90 grand to begin with. Start paying back that loan against the policy. It's like a line of credit. Knocked it down about 20, 30,000. Drew that money out, bought the next house. Did the same thing. Now the velocity is going up a little bit more, right? I'm getting more cash flow. It's going from 600 and change to almost 900. My 10% is going up a little bit because I'm doing more business. I'm paying it off faster and faster. At that point, I was able to do another one and another one and another one. I took that $90,000 life insurance policy and I've been able to deploy over $1.2 million from it since 2016. There is an engine that you can create. And then by creating that engine, we create a trust. And within that trust, my family is aware of where we send our capital, where we invest. We have meetings, if you will, as a board. And if you do not follow along the way that we have prescribed it, you are written out of the trust. You do not get trusted with, if you will, with the capital that's going to be created within the family assets. What I also require is that my children, as they get married, that they have to talk to Gary and get a life insurance policy on them and their spouse. A couple of different reasons. They need to follow the same pattern that we have put in place for us to ensure that that change happens. And I am the one that changes the trajectory of my family, like the John D. Rockefeller did. And the only way to do that and ensure that my children do that and then my grandchildren do that. Now, the other reason I did that is if my daughter married to her husband, something happens to him, there's a death benefit that helps her and she doesn't have to come back and live with me. So it's a little bit of a protection for myself and my own sanity. So on top of that, again, the perpetuation of the family wealth. Now, does it mean that if they choose not to, that they don't get something, right? I'm not writing them out of my will. We're just not allowing them to participate in the trust. This is how this keeps us protected and perpetuated. But if I do leave this earth and it doesn't quite work that way, can't say I didn't freaking try. The one thing that you're going to have to get right with, I'm going to leave you guys with this little thought process. If you're trying to change your mindset and change the direction of your entire family, it's going to get hard. It's not an easy thing to think ahead and do these things. You're going to see thoughts that come across or people give you certain advice that sounds great on paper, but it doesn't quite pencil out when it comes to reality. You don't know that yet. There's this old saying, good judgment comes from experience and experience comes from bad judgment. Great way to learn on the grade school playground, but a very shitty way to learn in real estate investing that can cost you a fortune and your entire livelihood if you make the wrong mistake. We have seen where thousands of people have done their business when it comes to real estate. We've seen where thousands of people failed and where thousands have succeeded. Anything you face, there's a question as to what you should do one hand or the other, call us. There's a very good chance a member of myself or a member of my team have seen somebody make that decision and the outcome. And we will share with you stories of what that is instead of just telling you what to do, because you need to learn with practical data, not speculation and theory. The other thing of it is as you're trying to make these adjustments, these things happen in your life, there's going to be questions brought to you. People will question your intent. You're already under a lot of pressure. One, if you're a business owner, you're under pressure just trying to maintain yourself, maintain your family, maintain your employees, maintain the things for the people who are doing business with you, ensure that everybody's winning. You're under a ton of pressure. Now you're completely changing how your family does things financially. They're going to be asking you your intent. You have to be able to explain it to them in a way that they get it and understand it and back you up, because otherwise it's crushing to be questioned in it when you know you're not going to benefit from it. And honestly, you might not. Your children are going to be ones who benefit from it. And if they don't perpetuate it, nobody benefits from it. So I appreciate you guys. If you need questions answered from me, you can go to my website, aaronchapman.com. I'll also encourage you, just text me, 602-291-3357. That's my personal cell phone right here. Text me, 602-291-3357. I saw you on the Think Realty, what have you, thing that this is. And I'll screenshot that, send that to Bree. Bree, my assistant, will sync up a time where you and I can talk. We will talk directly so we can guide you through whatever that is. So thank you, and I appreciate you guys taking the time.